Okay, so why don't we go ahead and get started if everybody is ready. I'll go ahead and kick things off. Hi, everyone. My name is Olivia Heinze. I am with the Generator team. Welcome to our fourth webinar for this week under the Alabama Emergency Response Program. Today's topic will be the federal response to COVID-19. This program today is brought to you by Generator and the Bronze Valley. We cannot thank the Bronze Valley enough for their partnership in this program. They have been incremental in helping us deliver these webinars and the one-on-one consultations for this program. So thank you to them. We really couldn't do it without them. If you prefer to dial in to today's webinar, we do have that option available to you. The dial-in information is 1-646-558-8656. And then the webinar ID is 920-9569-5877. We do welcome any questions throughout today's webinar. If you do have any questions, please use the question and answer box function down at the bottom. We will do our best to answer any questions as they come in, but we'll be hosting the last 15 to 20 minutes of the webinar to answer all the questions that you guys have asked. And outside of this, if you have any additional questions, feel free to email prentice@generator.com. Due to the nature and the number of people on today's webinar, we will not be able to assist with any technology issues. But we will be recording this webinar and sharing it with all registered emergency response program participants. So just keep an eye on your inbox if you're looking for the recording after today's webinar. And finally, I'd like to welcome our speakers. Today we have Jonathan Murphy. He is a partner at Fortif Law Partners, and Joel Jones. He's a director at Kassouf and Company. So without further ado, I'd like to kick it over to Jonathan and Joel now. Thank you guys both for presenting today.
Thank you. Olivia, is there a way for me to share my screen?
Yes, if you go down at the bottom, there we go.
All right.
All right.
Well, welcome everyone. I imagine some of us are experiencing some webinar fatigue, but we appreciate you participating today as the information continues to change and all the guidance that continues to come out from the SBA and Treasury and various federal agencies regarding how we can take advantage of the tools that they have provided us through the 3 phases of federal congressional action in response to COVID-19. And so we're grateful that you're joining us. It really has, I think everybody on the call, if you've been paying attention to the implementation of these various programs by different federal agencies, it's been a bit of a rigmarole. I think everyone is doing their absolute best at the agency level and the implementation level to interpret the law and the guidance and apply it in a way that will effectuate the intention of the congressional action. And yet we've had some conflicting guidance that's come out. At times even we saw Treasury and the SBA have to walk back some initial guidance because it was found unconstitutional or determined to be unconstitutional related to faith-based organizations. And so the information that we've been receiving has been coming fast, and it's been essential, I think, to stay abreast of what's going on. I appreciated yesterday in the Bronze Valley Generator presentation that the SBA presenter said they've had to start using timestamps instead of just current as of a certain date in order to keep everybody informed. But we're really grateful that you're participating today. I know some of these topics, including the Paycheck Protection Program and the Emergency Injury Disaster Loan Program, you've likely heard about in other webinars. And so we're going to provide a high-level overview of those programs, but we're also going to address quite a few others and really hone in on what Joel and I have been seeing in our practice as we've been advising our clients and really seeking to ensure that people are able to take advantage of these programs. So I want to start here and just give you a picture of the landscape of what the first three phases of congressional action effectively accomplished in order to benefit small businesses, some large businesses, nonprofits, and individuals. This is a slide that you'll see again at the end of the presentation. It's very important to Joel and I in preparing this, that we identified and made it easy for participants to see what they need to be focusing on. There's a lot in the CARES Act. There's a lot in the two acts prior to the CARES Act, and it can be hard to wrap your arms around. So we're trying to distill it as best we can through this presentation. So we'll return to this slide as we get to the end of our presentation as well. But we're going to start by just identifying what types of relief have been provided. This is just very high level. You've got the Paycheck Protection Program, which is a forgivable loan program, and we'll get into more detail on that. But you've got the EIDL as well, which is a loan and a grant program. You've got the prospective mid-sized business loan program, which this week has gotten a little bit more clarity around it, but nothing finalized. And that's also a loan program made to assist small to mid-sized businesses and nonprofits. You have a refundable employee retention credit, which is tax relief provided if you are either ineligible for the PPP or choose not to use the PPP. We've got payroll tax deferral, which is additional tax relief for these businesses who are suffering as a result of COVID-19. We've got expanded paid leave and FMLA, which is intended to provide relief to the employees of a lot of these businesses that are suffering. There's also expanded unemployment insurance, which is additionally employee relief. And finally, there's a host of other benefits that the federal government has provided through the first three phases of congressional action. We're anticipating a fourth congressional action, what people are referring to as phase 4. And there's a lot of speculation about what will be in phase 4, but really no material guidance from the top down has really been provided. But we're going to explore some of those federal tools. We're going to hone in on some of these less articulated, less explored portions of the federal response. But we're going to start where most of these presentations have started, and that's the Paycheck Protection Program, which, as Joel will explain, is undeniably right now the best benefit for companies that are eligible. So Joel, I'm going to hand it off to you to take the lead here.
Thank you, Jonathan, and I appreciate the opportunity to speak to you guys today. I hope everyone is safe and able to cope as best you can, because I know it's a difficult time for everyone. But I do appreciate the opportunity to provide some thoughts about some of these programs, and hopefully this is helpful. If you've got questions, chat them in, and we'll address them as best we can. I know the Paycheck Protection Loan Program, I think you guys got an in-depth webinar on that yesterday. So I just wanted to give you a high-level overview of this particular program, and then slow down a little bit when we get to the forgiveness piece, because that's on a lot of people's minds when I think about what are the questions that I'm getting the most right now. It's related to that component. And so, you know, the Paycheck Protection Program loan is active. Banks and lenders are receiving applications now. I've encouraged any business that is interested in this program to get an application in as quickly as possible, because it's a limited pool of money, a big pool of money, $349 billion, I think, but it's a limited pool. Now, there's some signaling that they're going to expand that pool if it gets fully utilized, but I do know that it has been dwindling as far as the availability of that pool. So all businesses that were that have less than 500 employees that were operating in February of 2020, for the most part, are eligible for this loan. Now, less than 500 employees, I did want to mention just kind of in passing, is there are attribution rules associated with that calculation. And so for what that means is businesses with common ownership have to aggregate the number of employees to try to determine eligibility. and that can be important to businesses that have venture fund investors. And so I just encourage you, if you've got that type of scenario, think about that as it impacts your Paycheck Protection Loan Program application. But for small businesses and sole proprietors, the go-live date was April 3rd. For independent contractors and self-employed individuals, the go-live date was April 10th. And so there's a lot of applications in process now. And then there is a forgiveness provision that you see in the center of your screen that you guys probably talked about yesterday. If you use it for what are called covered costs, which are payroll costs, interest on mortgages, rents, and utilities, then, and you stay within a parameter that 75% is spent on payroll, then you can apply for forgiveness of the loan at the end of the program. Subject to certain limitations based on whether or not you maintain your headcount and maintain your salary levels. So what do payroll costs include? And you probably talked through this yesterday. And when you're going through your lender, you'll talk about these things as well. But it's what you would expect, salaries, wages, payments for tips, payments for health insurance benefits and retirement plan benefits. That's something that I've seen sometimes get omitted when folks are putting their applications together. And then there are also limitations that apply to the amount of compensation that a particular employee receives. You have to limit the amount to $100,000. There's also some limitations. There's the $100,000 limit. And there was some question in the beginning about whether or not that includes benefits or not. Is it $100,000 in total, or is it $100,000 of salary plus benefits? At the end of the day, for most applications, it's $100,000 of prorated salary plus benefits. It gets a little bit more difficult when you get into some of the self-employed calculations and things like that. And then, there's a couple of other limitations. It has to be employees who are residing in the United States. And then there's some tax credit provisions under the Family First Coronavirus Response Act that allows companies to take tax credits related to payments under those programs. And if you're using those programs, you're not able to use the same costs for these Paycheck Protection Loan programs. And that's a common theme you're going to see in these programs. To where there's a lot of benefits out here, and there's a lot of things that companies can utilize during this process, but you have to be careful not to use the same costs for the same programs so that you don't misstep in these in the application of these programs. So how is the loan calculated? Again, just really quickly, it's 2.5 times monthly payroll, essentially. The way the lenders have been calculating this has been looking at 2019, what were your payroll costs, and then calculating a month of those payroll costs, and then multiplying that factor times 2.5 months. That's the way I've seen most of these things calculated. There's a limit up to $10 million of the maximum amount of loan that you can take. And then that at the bottom of your slide, you see there are some different rules that apply if you were not in business between February 15th and June 30th. And then one other thing I wanted to mention is there's also some things to think about if you're a seasonal employer to make sure that you account for those types of scenarios when you're running these calculations as well. So how do you apply? You apply through your lender, and then you have to do the certification components that you see on your slide and document your FTEs, document your payroll costs. A lot of the banks have been asking for proof of prior payroll tax returns, payroll journals, and things to kind of demonstrate what your pay has been. For self-employed people and independent contractors, a lot of times folks are having to provide copies of their Schedule Cs as applicable. And then for partners and partnerships, there's some additional information that some of the banks are asking for in those arenas as well. So this is where I kind of wanted to slow down a little bit, because the forgiveness piece is what's on everybody's minds now, at least on the minds of folks that have made their applications, because some of the funding is coming out now. And a lot of the questions that I've gotten over the past 3 or 4 days have been, all right, what do I do now? I got my money. from the bank. It hit my bank account. What am I supposed to do now? And so I think it's important to think about how the forgiveness piece works, because the forgiveness piece is formulaic based on what you spend your loan proceeds on. And so there's an 8-week period that starts from loan origination going forward. And to the extent you spend your loan proceeds on payroll costs, interest on covered mortgage obligations, covered rent obligations, and covered utilities, and you spend 75% of that loan proceeds on payroll, then you can apply for forgiveness. So when does that 8-week period start? Well, the Act indicates that it was loan origination. Late last week or early this week, either the SBA or Treasury put out some guidance that said that they're going to flag when the loan is funded. So for me, the way I think about it is, if my loan hits my bank account today on April 15th, I've got 8 weeks from today to spend it on the covered costs that you see on your screen. So you're looking around June 15th or so as far as having this stuff spent in accordance with the program, if forgiveness is what you're after. In the event, at the very bottom, when you get to the end of the program, if it's not forgiven, it converts to a term note that's a 2-year term note. At least the slide says maximum 10 years, maximum 4%. That's what the Act says. The SBA came out and said, we're going to use a 2-year term with an interest rate of 1%. And there's a 6-month deferral provision that says so the way this works mechanically is, I think you get to the end of the loan program, you apply for forgiveness. To the extent it's not forgiven, whatever's left is owed at that point as a traditional loan. There's a 6-month deferral process from that point. And then after 6 months, that loan is payable over the next, 16 months, 14 months? No, 18 months. Jeez, I'm not good at math. Next 18 months to get it paid out by the end of that 2-year period. All right, so the urgency that I think is on people's minds now is, I've gotten my money and I'm starting to use it. What do I need to be thinking about? And I believe that there's some urgency in the tracking of expenses because that 8-week period starts when it hits your bank account. And 8 weeks is, in my mind, both a long period of time and a short period of time, because it will go very, very quickly as we all try to cope with, trying to keep our business funded and track what we do and operate our business. But at the same time, 8 weeks is a long time to create documentation. And so if you get to the end of the 8 weeks and you're trying to look back and accumulate what you need, it's better to do it on the front side, in my mind. And so I'm encouraging clients to think about it now. Think about what kind of system do you want to create that allows you to track expenses, track what you've spent it on, and start documenting what you're going to need to apply for forgiveness. In my mind, the best way to do that is to create a separate bank account. Some banks are actually requiring that. I say some banks. I know of a bank for sure that is definitely requiring that, requiring a bank account set up that the loan is funded into that bank account. And then this particular bank is actually requiring customers to request a draw on that money, kind of like a construction loan. I only know of one bank doing that, but there may be others doing that. But I'm a fan of having a separate bank account just for the ease of tracking. When I think about what it's going to take to go back to the lender and request forgiveness, the best documentation I can think of is a series of bank statements that shows my money went in, I spent it on these things, and at the end of the period, I have nothing left. And here's the documentation that I have to support what I spent it on. Now, if you decide to go that path, there's a couple of other things to think about. A lot of companies will set up payroll accounts to process payroll. So they'll have an operating account and a payroll account. And the payroll account is linked to a payroll service or linked to QuickBooks or something that draws the money out when payroll tax time deposits come and things like that. And it's a pain to try to transfer that to another account. So I think in those scenarios, I don't think you necessarily need to draw payroll directly out of your Paycheck Protection loan bank account if you go that route. But I do think it makes sense to move money directly from your Paycheck Protection loan program bank account into your payroll account with documentation of what that is. To me, that's the best evidence of what you're doing is, my payroll during that 8-week period, I had a payroll period that ended on a Friday, and the payroll was $5,000, I moved $5,000 from my Paycheck Protection Loan Program account to my payroll account and then process that way. I'm a big fan of that because I just think it creates a really, really nice trail when time comes to demonstrate the loan or to apply for the loan forgiveness piece. The other thing I would do is create a system for tracking these costs. Being an accountant, I love Excel, I love spreadsheets. And so that's one way to do it, is start tracking what you've spent your money on in a spreadsheet. Today I spent this amount on utilities. That was, on this date, this dollar amount for this period. Tomorrow I spent this amount on my payroll, and it was these dollars. And the beauty of a spreadsheet is it allows you to accumulate your totals, so you're able to track what your total that you've spent so far is. And it also allows you to easily track those percentages, because remember, 75% should be spent on payroll. And so you're able to easily calculate that to try to see if you're on track. And then I also think it makes sense to start maintaining files of covered costs so that you've got, a file that shows this is what I've spent the money on. And then lastly, on that piece, some folks have tried to establish ways in QuickBooks or their other accounting systems to try to flag these costs. I think that's fine too. I just think at the end of the day, I would love to get to the end and be able to get 8 weeks from now and be able to create a report very, very easily without a whole lot of pain that shows what I have spent the money on during that period. And then the last thing I want to mention as far as the tracking goes is being mindful of tracking your head count, because the forgiveness piece, there are limitations to the forgiveness based on reductions of head count and reductions on payroll. And so I think it makes sense to baseline that stuff at the very beginning and then monitor that throughout the 8-week period to see if you're to make sure that you fall within those parameters and you don't get to the end and say, well, I missed it by 1 head count or something like that. And then the last thing in this, there's some question, ultimately of what are we going to have to provide to the bank when it's all said and done when we apply for forgiveness. And, we don't know for sure yet because I think there'll be some guidance come out in the next 8 weeks to try to give an idea of specifically what we're going to need. But the Act actually kind of indicates what's going to be required and provides that some of the things that you're going to need are the things that you see on your screen, which are straight out of the Act. Documentation of your head count and your pay rates as supported by payroll tax filings during the covered period, cancel checks and receipts for things that show that you paid it on covered mortgage obligations, covered lease obligations, covered utility payments. So those are the types of records that you're going to need. That's why I say it makes sense to start accumulating those now. And then one other thing I wanted to mention here is if you receive an EIDL loan and a Paycheck Protection Program loan, you have to be careful not to spend the money on the same things. And so just documentation on the very front side of I spent this amount of money out of my Paycheck Protection Loan proceeds on this. And if I also have an EIDL loan, I spent that money on this. And here is the trail that shows that I did that. We've got a couple slides that show the applications. I think you guys probably saw that yesterday. And when you go to your lender, if you haven't done that already, you'll walk through this, this application process.
All right. Well, thank you, Joel.
Yep.
We'll be coming back to you in just a minute. One interesting thing that I would note on the Paycheck Protection Program before we move on is, I think as of yesterday, the SBA had announced that 246 of the 349 billion was already spoken for. And so I think there's an expectation amongst different practitioners that we might see that the full funding is exhausted potentially by the end of the week, mid next week. So if you haven't applied and you are interested, I would encourage you to go ahead and start contacting your lender, your accountant, your attorney in order to get that ball rolling quickly. But that really, the PPP is really the more attractive of most of the federal relief programs, primarily because it's a forgivable loan. And I think it's got a lot of folks' attention as a result of that. Now, moving on to the economic injury disaster loan, what we refer to as the EIDL. The EIDL is similar in some respects to the PPP. and it differs in some significant respects. It's similar in that the sizing of the companies is the same, as long as you have less than 500 or fewer employees, and we're operating as of January 31st as opposed to February 15th. Quite a few entities are eligible. In fact, under the EIDL, the eligibility of these entities is much broader than the PPP. Specifically, looking at nonprofits. Nonprofits in the PPP realm have to either be a 501c3, a tribal organization, or a church. But in the EIDL, if you are exempt under 501c, D, or E, then you qualify, which I think is significant. Again, we're just going to do a high level on this because most of the viewers are probably familiar with it. But you are allowed to have EIDL and PPP loans at once. As Joel mentioned, it's really important that you do not use the funds for the same purpose, which can be a confusing thing to navigate. But the examples that we've been given are that you couldn't use PPP and EIDL loan funding to pay payroll in any given month. You would need to use EIDL for 1 month and PPP for another month. And that's the example they provided. You could use EIDL for mortgage and PPP for payroll. You can mix it up a little bit. Beyond the fact that the EIDL is not a forgivable loan, which is the most significant difference, the grant program that was intended to accompany the EIDL is one of the more interesting pieces of it. So the design, the intention was that there would be an advance of $10,000 for anyone who requested it after applying for an EIDL loan. In reality, what we've seen, and some of the guidance we've gotten from our Alabama SBDC, is that the amount of the loan and the amount of time it takes to receive the loan has been adjusted. So what we're seeing happen in reality, and my wife applied for an EIDL loan, I'll say, and this is certainly her reality. After applying and requesting the grant, excuse me one moment, I've got some background noise here. After applying for the grant, the time to receipt of the check was 7 days, and she applied as a self-employed individual. Excuse me one moment. Having some technical difficulties here. All right, I'm back. My apologies. So what's ended up happening is it looks like they're giving out these grants basically using $1,000 per employee up to $10,000. That's been the sense that we've been getting. And it's taking a little bit longer to receive that funding than initially thought. The EIDL loans, though, are still attractive. If you're ineligible for the PPP, or if you're looking for a loan that you can use for a broader amount of uses, you can apply for up to $2 million. And they do require collateral on certain loan sizes, but they don't if it's below $25,000. So the EIDL, you have to apply directly through the SBA. The interest rates are very attractive. If you're a business, it's 3.75. You're a nonprofit, it's 2.75. And you can effectively use the money to pay for normal operating expenses, including payroll, but not limited to payroll, that you would have had to pay if the disaster had not occurred, which is a very broad, permissive description of the uses of the funds. And the reason for that, I think, is very reasonably that this is not a forgivable loan. And so the PPP imposes additional restrictions because of the forgivable nature of the loan. So they are waiving principal and interest payments through the rest of 2020, different from the PPP again, which was only a 6-month waiver. And I think that is probably a high level coverage for the EIDL. I want to talk for a moment, though, about the mid-sized business loan program. We've been receiving a lot of questions from businesses who are exempt from the PPP and EIDL because of their size. They're sort of left wondering if there's anything in the act for them. And there is. So the mid-sized business loan program was a broad authorization to Treasury to provide financing to lenders in order to direct loans to eligible businesses. And eligible businesses was described in the act as being between 500 and 10,000 employees. Now we'll see that the first example of what this mid-sized business loan program looks like actually doesn't include the floor of 500 employees, which is fascinating. The act suggests that there are quite a few certifications that you have to make around retaining or restoring your workforce to previous pre-COVID levels. There are other restrictions, though, that participating companies will have to pay close attention to. Interest rates on these loans are supposed to be very low, not higher than 2%, could potentially be lower than 2%, and there'll be a deferred payment schedule. The first example, though, that we've seen of how this money is being doled out is the Main Street loans. This actually came out this week, and it's going to enable $600 billion of loans from approved lenders. Basically, what we're seeing is that it's allowing for 4-year loans. If it's a brand new loan through the Main Street loan program, it's capped at $25 million. If you already have a loan, you can add on to that loan up to $150 million. They're deferring payments, principal and interest, for a year. And you're eligible if you have up to 10,000 employees or up to $2.5 billion in annual revenue, looking at 2019. As I mentioned a moment ago, it appears that they're not applying the 500 employee floor, although they have not finalized this program yet. In fact, they're accepting comments through April 16th before they finalize it and launch. So if you're a mid-sized company or nonprofit, I would pay close attention to this. If you're a business who's excluded based on the affiliation rules from the PPP or the EIDL, if you're a startup that's venture capital backed, and so the affiliation rules boxed you out of those other loan programs, this is something to consider and really keep a close eye on. So there are also a few other programs that are going to be financed through this mid-size business loan program. We don't have enough details on them to really discuss them today, but keep your eyes open. All right, I'm going to pass it back to Joel here to talk about one of the undersung but really valuable tools that has been provided through the CARES Act.
Thank you, Jonathan. I agree. Everybody has been focused on the Paycheck Protection Loan Program and getting that funding, understandably so, because it's such a great program, and then the EIDL loans, because those are such great programs as well. But there's a couple of other things that are in the acts related to payroll tax credits and payroll tax deferrals that I think can help businesses who either are too large for the Paycheck Protection Loan Program, either based on employee count as they have them, or based on those affiliation rules, like you mentioned, if there's venture capital or something like that involved. And one of those is the Refundable Employee Retention Credit. And so one of the common themes of all of these programs is to create mechanisms that give employers the ability to keep employees on payroll somehow or another. And that is taken the form of loans, that is taken the form of tax credits. And that's the way all of these things are designed. And this employee retention credit is the same, is one of those programs. So if you, on the left hand of your screen, you see who is an eligible employer. So, businesses that carry on a trade or business, including a tax exempt organization during 2020, Well, that just means that you were in business, and then that you were either had operations suspended fully or partially during any calendar quarter in 2020 due to COVID-19, which is virtually all businesses, or experienced a significant decline in gross receipts during the calendar quarter. Now, the way that is measured is what was my revenue in this quarter versus my revenue last quarter, and did I have a 50% or more decline? If I meet either of those as an employer, then I am eligible to avail myself of this particular credit provision. The way this credit provision works is it allows employers to, it creates a credit for employers of up to 50% of qualified wages. And mechanically, the way that works is employers are able to short their payroll tax deposits in amounts equal to the credit provisions. Now, it is applicable to wages paid after March the 12th, before January 1st of 2021. So you're talking about 2020 wages from this point forward. And it's capped on $10,000 of wages per employee. So you're effectively at $5,000 of credit per employee. So what does that mean for us as employers? It means that we need to monitor what we're paying our employees. It's a per employee credit. Calculate the credit, 50% of that, to know what that number is. Once I know what that credit is, then I'm able to offset my payroll tax, my employer portion of Social Security is the mechanism for taking this credit. And it's going to fall out on your 941 starting with the second quarter of 2020. When those are filed, there'll be changes to the 941 to take that into account. Now, there is one thing to consider, however, is if you have availed yourself of the Paycheck Protection Loan Program, you are not able to use this credit provision. So it's an either or. So a lot of businesses are had to make decisions of, did I want to get the Paycheck Protection Loan Program, or did I want to try to use some of these credits? Now, there's just as an aside, these credits are fantastic programs. They're a great way to keep cash flowing in a business. But from my perspective, you still got to have the cash to make the payment. So the way it mechanically works is you process payroll, calculate your credit, and then you short your payroll tax deposit equal to the amount of your credit. Well, all of that requires the business to have cash to do that, which is and the Paycheck Protection Loan programs provide cash in order to maintain, in order to process covered costs. And so it's a decision to make of, if I don't have the cash, the credit provisions are not as helpful as the Paycheck Protection Loan programs. But it is an either or, so it's something to think about. And it's really something to think about for companies that are over the 500 employee limit, either because of the number of employees directly or because of the affiliation rules. Another one that I really think is flying under the radar is the payroll tax deferral provision. So on the payroll tax deferral provision, it allows all employers to short their payroll tax deposits related to the employer side of Social Security. So, mechanically process your payroll the way you normally would, calculate your payroll. When you go to make your payroll tax deposit, you always have to say, this was the federal withholding, this was the Social Security withholding, this was the Medicare withholding, and this was the employer side of Social Security and Medicare. Well, you're able to not pay that Social Security piece under this provision. And then to the extent you have done that, 50% of the amount that you retained is due in 2021, and the other 50% is due in 2022. So it is an interest-free loan available to all employers under this provision. Now, there is a catch. There's always a catch. So if you look at that first line in the slide of the middle section, doesn't apply to companies who had debt forgiveness. So the IRS put some questions out, some frequently asked questions, I think within the last 3 or 4 or 5 days, that says, all right, what does this mean? Well, mechanically, what that means is if I'm an employer, I can start shorting my payroll tax deposits related to the employer side of Social Security up until the Paycheck Protection Loan Program forgiveness occurs. So think about it. Let's use a real example today. If I decide to start doing that today, and I get my Paycheck Protection Loan Program loan today, I've got 8 weeks of Paycheck Protection Loan Program to spend that. Then I apply for forgiveness at the end of that 8 weeks. There's supposed to be a 60-day window once you apply for forgiveness that the banks are supposed to respond. Whenever the bank comes back and says you are forgiven or you are not forgiven or whatever that ultimate determination is, that's the trigger to where payroll tax deferrals are no longer allowed for that particular taxpayer. But that means that during the time leading up to that, you have the ability to avail yourself of this. So that's a pretty effective way to go about doing this. And I do think for companies that are more than 500 employees or that or under the affiliation rules are trapped by that 500 employee limit, this is also a very, very useful tool because you don't even have to worry about that debt forgiveness piece. So you can avail yourself of this all the way through the end of 20. The next piece that I had, until there's a little bit of a lag on the slide advancement, I think, is I wanted to talk briefly about the expanded FMLA and the paid leave. And I know you guys are getting a deep dive on this tomorrow, I believe. But you know, the FMLA piece and the paid leave piece came in with the Families First Coronavirus Response Act and is applicable as of, I think, April the 1st is when that went into account, when that went into effect. And it requires companies with less than 500 employees to provide FMLA and provide leave based on for employees that were adversely affected by the COVID-19. And there are specific things to think about as it relates to that. And there are specific scenarios created under that related to closing of schools, related to I'm sick, or and this is from an employee's perspective. An employee is sick, an employee is taking care of someone who is sick. All of those things play into this, but companies of less than 500 are now subject to this. And that's important because before the FMLA limits were only applicable to companies with 50 or more employees. Well, now companies with 50 or less employees are subject to these rules. And so, you know, I encourage you to participate in the webinar tomorrow to get a deep dive on that. And I did want to mention for companies that have employees who are taking leave under these provisions, there are tax credits available under these provisions. So keep in mind what we said earlier, that all of these programs are designed to encourage employers to keep employees on payroll, even if they're sick or affected by COVID or any of those things. And as a result of that, there's credit provisions available under the Families First Coronavirus Response Act to help employers pay employees who are affected by this as well. Just remember, just be really, really careful if you're doing all of these programs to be sure that you're not using the same programs for the same costs. But I feel like there'll be more of this information in the program tomorrow as it relates to these particular provisions. And then I think the final part I was going to kick back to Jonathan to talk about the expanded unemployment insurance.
Yes, forgive me, you all. My neighbor was doing some construction on his house, and so I didn't want it to interfere with our audio. So I've been trying my best to switch over. I'm going to share my screen once again. Let's see. All right, are you all able to see the presentation again?
Yes.
All right, my apologies. So it's really valuable for us to dive into some of these other considerations and expanded unemployment insurance, and we'll do this very briefly so we have time for questions. But the CARES Act also provides an expansion of the current unemployment model. Basically, if you're unable to work or your work hours are reduced as a result of coronavirus, you're eligible for expanded benefits. You can apply through the state, and effectively you will receive $600 a week in addition to whatever your state program already provides you. And that is something that is very compelling to employees. I think $600 a week standing alone is more than some employees make in any given week. So that, in addition to the state benefit, I think is very helpful. The thought there being, let's inject some cash into the market, and let's ensure that these employees are able to take care of their expenses while they have to be at home. So that's an important point. Another point for us to be paying attention to is the stimulus that's coming out from the federal government that will reach each state. The expectation is that Alabama will receive $1.9 billion. That'll be distributed by the state according to some very broad restrictions, but they are required to provide a certain allocation to counties and cities with populations over 500,000, which in Alabama, I think is limited to Jefferson County, interestingly enough. So pay attention to this. And insofar as you have mechanisms to interact with your representative, ensure that you are engaging them on the ways in which you believe that those funds should be distributed. So I think, I know the state is working hard right now to plan for that, but use your voice to influence that action. Small business debt relief. If you already have an SBA loan, you're allowed to have some debt relief for a period of 6 months, which is really, really interesting. Something to look at. And finally, just some of a high level of a few other points that were interesting. I think everyone started receiving their rebates, their individual rebates within the last week. I know mine hit my bank account this morning. My wife's hit her bank account yesterday. So if you haven't received it yet, it should be coming. As you know, it's reduced based on how much you make. It's larger for married couples, just because if you file jointly, you'll get the full amount you would have as individuals. And that's increased if you have dependents under the age of 17. There's funding that's being doled out through the CARES Act all over the place. I mean, I would encourage everyone to ensure that you're monitoring grants.gov, which is a source where the federal agencies will post funding opportunities. I know I saw one for higher education yesterday that provides support to students. And I hadn't seen it in the news anywhere. I know that there is quite a lot in the healthcare and human services realm as well that's being posted on grants.gov. And this is basically federal agencies taking the monies that were appropriated to them through the CARES Act and providing them to eligible organizations. While it can sometimes be rare, there are occasions in which for-profit businesses are eligible for those grant funds. So I would pay close attention to grants.gov. If you're a nonprofit and you haven't registered through sam.gov, you need to do that yesterday, because that process can take a few days to get approval. You have to get a DUNS number, a CAGE code, register with grants.gov, then register with sam.gov, and you need to do that. You need to do that ASAP. We'll go ahead and wrap up here and move on to Q&A. I want to land here again, though. We'll leave this up as we do Q&A. Remember that there are quite a few programs that have been provided, and you don't want to pay attention to some at the neglect of others. But make sure you're taking advantage of it, because these are trying times, and we've been afforded some tools that we can use, that we ought to use. So thank you. Olivia?
Yeah, awesome. Thank you, Jonathan. Thank you, Joel. As Jonathan just mentioned, we're going to go through the questions that you guys have asked now. So I'll read them off, and then Jonathan and Joel, if you want to take a stab at answering them. The first question is, if you apply and receive both types of forgivable loans, should you open a separate bank account for each to make tracking easier?
This is Joel. I would. It's not required, but for me personally, I think about, what if I was coming, and I don't audit anymore. I'm a tax guy, but when I used to audit, it was all right. If I was going to audit these provisions, what would I be looking for? And to me, the best way to demonstrate the use of the funds is to have the funds segregated. So if I've got an EIDL account and I have a PPP account, for lack of a better term, and I can show, where the funds are coming out, Here's where I spent my EIDL money, and here's specifically what I spent it on, and here's it coming out of the account. And here's my Paycheck Protection Loan Program, and it's coming out of this account. I personally believe that's the best evidence. It doesn't mean that you have to. There's no requirement, to my knowledge, to separate those. I just think it makes sense to do that if possible.
Awesome. Thank you. And then this question is regarding the employee retention credit. The question is, to clarify, the business or organization can only retain the employer contribution to Social Security, not employer contribution to Medicare.
That is correct. Just the Social Security piece only. Just the employer Social Security piece only. So that's exactly correct.
Awesome. And then another question, and to be clear, 501c6 organizations are eligible for employee retention tax credit. They have been excluded from most all other assistance programs.
If you're conducting lobbying activities, you can't use funding for that purpose. But I do believe that you are eligible under the employee retention tax credit. Joel, do you have any thoughts on that?
I think that's right. I'll be honest, I had snuck a look at the questions and I was trying to find the answer in the act, and I ran out of time. So I'm going to say, I agree. I think you're right. I would love the opportunity to confirm, but I think that's right. My gut is you're correct. Yeah.
Okay, and so that question is from Heather New. Let's make a note to follow up with that. Okay, and then the next question, would the $600 federal expanded benefit be the same for employees who are furloughed or fired versus those with reduced hours?
So I'm going to get back to you on that. Tomorrow, we're actually going to be discussing the employee impact on of the CARES Act. We're going to be looking through the employment law implications. And so I would encourage you to tune in tomorrow, and we will go into depth on questions like that.
Awesome. Okay. And so this question is, if an entity receives an EIDL emergency advance, can they still use the employee retention tax credit?
This is Joel. I think so. I have not seen anything to restrict the ability of to use the employee retention tax credit related to an EIDL emergency advance. I haven't seen anything to restrict that at all. So I think you can, yes.
I think that's right.
Okay. Awesome. So we will follow up with both Heather and Mary related to those questions. I've saved them and screenshotted them. So we'll be sure to follow up with both of you. But I think that wraps up all the questions that we have today. We do have about 5 more minutes, but I'm going to go ahead and share my screen now. Alrighty, well, if we don't have any other questions, thank you all for joining us on this webinar. As we mentioned earlier, this is our third for the week for this Alabama Emergency Response Program, and we will have a couple more this week. We have one tomorrow, and then we have one on Friday as well. As Jonathan and Joel mentioned, tomorrow's webinar will be surrounding employment law and local resources specific to Alabama. So we'd love for you guys to tune in then. And then on Friday, our webinar is various tactics and strategies to cope with mental health and anxiety during this time for small business owners. But Jonathan and Joel, thank you so much for today. This was amazing. We also mentioned earlier that we'll be sending out this recorded webinar to all of the folks that have registered for the Emergency Response Program. And if you have any other questions, please feel free to reach out to either myself or Prentice. And our emails are olivia@generator.com and prentice@generator.com. All right, thanks, guys. Alrighty, take care, you guys. Thank you so much.
All right.
Thanks, everyone. Bye-bye.